Index will come up on your screen, and I think there as well there isn't very much at all which is kind of discernible in any meaningful way. So it's flattish, I guess, this morning. I think the Nifty 50 heat map will give you a quick sense of how we're starting, and then we look at individual names with regards to moves. HDFC Life, SBI Life. I mean, so the life insurance data, came through. And I think the reaction is on account of that. On the other end, you've got Max Health, BEL and Indigo, which are coming up under pressure at this point. 20 points lower on the Nifty is what you have. It's absolutely flat. Rima.
Well, Avenue Supermarts is a standout performer, 2.5% up. We knew the revenue growth numbers at 13.5%, but the street likes the improvement in margins. Avenue Supermarts has opened up strong. Then you've got HDFC Life, SBI Life, both of them gaining nearly 1%. Hindalco continues with its up move, so that surged over 1% in early trade. Some of these stocks, on which are dependent on crude prices, are moving in different directions. So Brent crude price surged on the back of rising risk in Iran. Brent is at $63.50 per barrel, almost hit 64. Asian Paints is up 0.5%, but on the flip side, you've got Interglobe Aviation, which is down nearly 1%. And some of these oil marketing companies should also come up for you on your screen. IOC has a downtick to begin trade with. One of the stocks which is in news today is Lemon Tree Hotels, where there is monetization, restructuring, value unlocking. Lemon Tree Hotels has opened up with strength. BEL is seeing some profit booking after last week's run. Defense, rearmament is emerging as a big theme globally, and even stocks in India had a good run. BEL from the start of January is up nearly 3.5%, but seeing some profit booking. Eternal opening up in the red. Apollo Hospitals, ICICI Bank. In fact, HDFC Bank and Reliance Industries should also come up for you on your screen since they were the big drags last week. HDFC Bank down 0.25% and Reliance Industries down nearly half.
Well, a few stocks that are actually outperforming today. IRDA, well, that stock is up and about in today's trading session. Good move is what we're seeing, up closer around 4%. The profitability was up by close to 37%, and the NII is up close to around 35%. Remember, the stock is a half of what it was at its peak, but that one's seeing a bit of a relief rally. Manappuram Finance, remember, that stock got slammed in Friday's trading session, particularly towards the end of trade. Now, the management has denied Reuters' report of RBI raising concerns with regard to the deal that they've done with Bain Capital. So that explains why that stock is bouncing back. Metals, they're back in focus. They had a couple of off-trading sessions last week, but Hindustan Zinc is moving up. That's the only way to play silver. And Vedanta, since it's a parent of Hindustan Zinc, and the demerger is moving in the right direction. So we see that that one as well is participating on the upside. Hindustan Copper, that's the other stock that's doing pretty well in there. That one, in fact, up and about in today's trading session. What's not doing too well? Tejas Networks continues to struggle. The stock is now down close to around 6%. Intense selling pressure is what we're seeing on that name. Remember, that's a stock which is a third of what it was at its peak, but no relief being seen on that stock itself. Net, the markets are lower. The Nifty is down close to around 60 points, but the street will be hoping at some point of time you will see some kind of an uptick because the FI short positions are at aggressive levels and the PCR is at around 0.64, which is the lower end of the band.
All right. Well, Harish Krishnan is with us, co-CIO and head of equity at Aditya Birla Sun Life Asset Management Company. Markets, of course, starting lower. Harish, good morning. Good to have you with us here. Our first chat of 2026. So let's hope the remainder of 26 is not how we've started this year off, which has been painful, Harish. And, so many money managers now talking about how they've kind of sort of reoriented and moved to large caps entirely because maybe the call is that in mid and small caps, it'll take time and perhaps there is pain for the foreseeable future. I don't know if you have a view on that specific thought process, Harish.
Happy New Year to you and to your viewers, Prashant. So we do have a similar kind of a construct wherein we do think that larger companies have a far greater risk reward. And this is borne by two particular data points. One is that we do think that, given the fact that there has been a pivot towards consumption, there is a certain amount of focus moving away from B2B franchises, which have done very well from 2020 to 2024. And we do think that there are certain set of sectors and themes which are going to be the winners of the next 2, 3, 4 years, which are markedly different from the winners of the past cycle. So there are 9 sectors which underperformed in the last 3 to 4 years, on which we think at least some of these sectors may end up being the big winners. And if you look at these 9 sectors, which includes banks, which includes IT services, which includes metals, cement, textiles, chemicals, FMCG, oil and gas and energy, etc., overwhelming amount of these sectors have a larger representation in the larger companies rather than in the small cap companies. Flip back 3, 4 years back, wherein the call was more on going into the investment theme. And at that point of time, if you recall, on the PSU side, barring maybe a couple of names, almost everything was in the mid and small cap. If you look at capital goods, barring say 2 or 3 names, everything was in the mid and small cap. And so therefore, there was a greater strength going into the mid and small cap at that point of time. So that's point number one. The second point is that there has been a lot of money chasing the small caps over the course of the last 3, 4 years. And just to give you in numbers, close to about 23% of the total AUM of the Indian mutual fund industry is into small caps, which is 251 and below, which account for about 11% of total profit pools. So this is a bus which is significantly overcrowded. And while there are a lot of good, interesting names out there which can potentially surprise, we think that the overwhelming risk reward is still with the larger companies at this point of time.
So, Harish, getting back to the first point, you're saying 9 sectors had underperformed, and you outlined the 9 sectors over the last 2 or 3 years. Now, over the next 12 to 18 months, which of these 9 sectors have enough in their fundamentals to do well and outperform from here on?
So we think that there are 3 particular sectors which are dark horses at this point of time. One is the consumption pack, wherein there has been a significant amount of reset from the government side, which is focused on both tax cuts as well as monetary stimulus. This has been an area wherein companies have kind of focused on margins over volume growth over the course of the last almost 4-5 years. And what we've now been seeing in the last year or so is the focus back on volumes rather than margins. So many of the leading FMCG companies have cut down their margin guidance by focusing on volumes, and have also started using the cash flows to buy bolt-on acquisitions to further their growth agenda. So I think that is an interesting area of point. The second is IT services, wherein while we do acknowledge that there is a threat of the AI, which can kind of disrupt many of the incumbents. The reality is, I think that expectations are running very, very low. This is a space wherein a lot of companies will use a lot of these IT services to actually, do the change as far as AIification of their enterprises. And therefore, for some of them, we do think that this is a great opportunity, especially with the currency where it is in the 90s. We think that that's again a space that can be quite interesting. The third area that we think is a dark horse is the material sector, be it chemicals, building materials. Again, these are spaces where we've seen a significant amount of underperformance. In many of them, there has been a large capex or a large gross block addition, which is not contributing yet in terms of revenues. And so these are the 3 broad areas, along with metals, which has had a great 2025 and which we had kind of picked out as a dark horse at that point of time. We continue to maintain a positive stance. So these would be the areas where we do think that either there is increasing margin of safety or there is a potential catalyst over the course of the next 18 to 24 months that can drive up as far as value creation is concerned.
All right. Hi, Harish. Good to see you in. And consumption, as you mentioned, various fiscal as well as monetary measures have been put in place to boost consumption. And if I got that number correct, you mentioned in your note around $7 billion USD is the kind of push that we have seen. What do you like out there? If you could drill it down a little bit more.
Sure. So I think on the FMCG pack itself, there is reasonable amount of under ownership. This is like a pack wherein most people have a view that, valuations still are expensive. But we do think that there is opportunity out here, even though headline numbers are quite large, are quite steep. The reality is that many of them are throwing significant cash, and we think that incrementally they are headed in the right direction of focusing on volume. So here we have plays which are either into very niche personal care or into the food space, where we are a lot more positive, where the scope for quick commerce-led disruption is meaningfully lesser. The other area that we are positive on is in terms of consumer durables. Again, a space where revenue pools are very, very large, but margins are extremely low. And we do think that, listing of many of these franchises will bring in certain amount of pricing discipline. This is a space, if you recall, say 5 years back, many of these B2C franchises in the durable space used to trade at 5-7 times price to sales. They've all derated to anywhere between 2 to 3 times price to sales, whereas the B2B franchises, which used to trade at, say, less than 1 time price to sales, have moved to close to about 4 to 5 times price to sales. We do think that there is a point to transition from the B2B franchises to the B2C franchises. So on the consumer basket, this is where, increasingly we are finding value.
Okay, all right. And another point, Harish, which we have discussed in the past as well, that the Nifty in gold terms is at its cheapest that we have seen all the way since the pandemic. But gold, going by the geopolitical tensions that we are seeing and, Mr. Trump, plenty of uncertainty exists in the globe. And that's why, you'll have gold that will continue to hold its own. And maybe the central bank buying as well does hold on. In that case, it'll be difficult for gold to fall from here. But you believe there's a strong case that the Nifty or equities actually outperforms gold from here on?
We do think so. Just go back to the COVID pandemic times. In March of 2020, I would imagine that the overwhelming thought process would be that we are not sure of how our own lives, our own safety would be. Forget about cash flows of companies. And that is where, peak fear psychosis kind of took over. And at that point of time, if Nifty in gold terms had kind of bottomed out, and that's the same level which is bottomed out in at the GFC level, at the dot-com level, etc. Invariably, living through these motions might always kind of give a sense that, even more worse things are going to come through. And potentially it can. See, all we are saying is from a probabilistic kind of a time frame, given that, over the course of the last 30 years, equities in gold terms have kind of bottomed out here. From a medium-term perspective, it does make sense that, one should be increasingly allocated more and more to equities rather than to precious metals. Now, whether this will play out in 3 months, whether this will play out in 6 months, 18 months, 24 months is anyone's guess. It'll only be in hindsight that we'll really know. But my limited point is, when we go through all of these motions as we have during .com, during GFC, during COVID, I'm sure that there would have been peak uncertainty. And each time the nature of the uncertainty and the catalyst of that uncertainty is very, very different. And it will always appear that, these risk-free assets or these safety assets one needs to really load up on at that point of time. And I'm not saying that, gold will not perform. Don't get me wrong. All I'm saying is that incrementally one should be better off allocating to equities as an asset class from a medium-term perspective, rather than just purely chasing price action of precious metals.
All right, just take a look at the Nifty, guys. We are breaching crucial levels as we speak. The 20 DMA is gone, the 50 DMA is gone, and now the 100 DMA as well is gone. And we're at the low point of the day, 150 points. Just wondering whether the street is fearing something that's not really come to light as of now, because, we've underperformed last week. And in today's trading session, we're trading for the last 13 minutes and we're down 150 points. The Nifty Bank is trading way below the 20 DMA as well.
And look at the mid-cap index.
Is there something unknown that is plaguing the street as of now?
Nigel, I don't think so. I think it's just, there is a sense of despondency which is set in. And you talk to a range of players that becomes very clear on air and sometimes off air as well. That's why I started by asking Harish, a lot of fund managers managing large amounts of money saying that, well, now I'm just sort of protecting NAV, protecting capital, moving to large caps. And some have sort of done it over the last 3-4 months. Some of course, some are doing it now. I don't think there's anything new in that sense the market's responding to. But it's just, there are no triggers at hand. Maybe third quarter earnings, but again, their expectations are fairly well advertised and little by way of surprise, I think, expected. Maybe in terms of single stocks, etc., here and there, they may be. But on an overall basis, yes, there'll be some strength, etc. But I think, as I said, it's well known and people realize all of that. So without any meaningful turns around the corner, I think it's just kind of a broad sale which is underway. 0.5% lower on the Nifty is what you have. Look at BHEL. We had Renu with us in the morning, right? Renu Bedab, IIFL. BHEL is down 5.5%. It's the number one volume-led loser on the NSE. And look at Hitachi, which is Power India. It's down 5%. It's under 17,000 rupees now. And maybe we should look at the others as well, right? GE Vernova. transformers and rectifiers, etc. I'm not sure if this action there. GE is down about 3%. CG and transformers, 4% on transformers, and CG, etc. will also come up on your screen. So, I mean, that's the picture. Just a quick word, Harish, on just that. I mean, it's just a market question more than anything else. I mean, this is not time correction. Let it correct. Let prices grow into earnings kind of a space. I mean, there is aggressive de-risking in mid and small caps, Harish.
Yeah, so I think as you laid out, catalyst in the sense of earnings growth, we do think an incrementally on the margin that is going to be an improving earnings growth, but how much is already in the price? And like I said, the bus is largely overcrowded. When we have, say, 22-23% of total AUM in small cap with 11% profit pool share, we do know that the bus is significantly overcrowded. So it doesn't mean that, you can't create winners out of small caps, but as an aggregate, even if earnings does come through, is there a room for element of surprise? Is there room for element of further buying that can emerge from these kind of names? We kind of think otherwise, and which is where we think that there are pockets of mean reversion rather than looking at the last cycle winners. So I can say that from a small cap perspective, where we do see value and where we are buying in this fall is a lot of consumer names, a lot of consumer oriented small cap names in the material space, in the consumer durable space. They are available at 3 to 4% cash flow yield, a free cash flow yield. I'm not even talking about earnings yield, etc. A lot of them are throwing 500-600 crores of cash flow available at 13,000-14,000 crores market cap with a net cash balance sheet, a lot of capex done. So there is opportunity out here. It is just that a lot of money still is in the winners of the last cycle, and therefore I'm not saying that these names are going to fly through in the next 3 months, 6 months. But we do think that there is opportunity even in the small cap. It's just that the nature of the winners are going to be very, very different. And one needs to therefore view the lens and the opportunity basket from a very fresh lens rather than getting anchored to what we already own.
Harish, we leave the conversation here. Thank you very much for joining in. But we'll watch out for the dark horses that you outlined, which could potentially do well this year: consumer, IT, and materials, which includes chemicals, building materials, etc. But look at the mid-cap index and the small-cap index. The mid-cap index is down 1%, and the small-cap index is down over 1.5%. And this is over and above the 3.5% fall that we had in the small-cap index just last week. And the advanced decline ratio, the gap between the two, will come up: one stock in the green for more than 5 stocks in the red. But now let's focus on the textile sector. The expected ruling by the Supreme Court on Trump's tariff powers did not come through. Now all eyes will be on the Supreme Court as they will deliver the verdict, hopefully, on the 14th of this month. But it's also been 4.5 months where the Indian textile industry has been facing the crushing 50% tariffs. So what's been the situation on the ground? R.K. Vij, National President at Textile Association of India, and Pallab Banerjee, MD and Group President at Pearl Global, are now joining in. Gentlemen, thank you very much for joining in. We were all hoping that the next time we speak, there would have been a resolution to the tariff issue. But as I began by saying, it's been 4.5 months. In August of 2025, Donald Trump, the president of US, imposed a 25 plus 25% tariffs on India. So since then, we've been reeling with that. So Mr. Banerjee, can you give us the situation on the ground now? And then, Mr. Vij, I would like you to throw in what you've seen in terms of have companies folded? What is the order book? How are they managing this? Mr. Banerjee, you want to go first?
Thank you. Thank you for having me on this call. Definitely 4.5 months, long time. And most of the customers at this point of time don't have, they are not going to give us that support until they see that there is a light end of the tunnel. So that's what is happening for India. For order books and all, yes, all the Indian suppliers, we book the business with some kind of, tariff sharing with our customers. And that's still continuing, but it's not sustainable. And for Pearl, definitely we have options outside of India. So most of this business, we are under pressure to move more and more into those countries. And that's happening. So yes, from Pearl point of view, it is good. We have more than 70% of our business, which is outside of India. And in the India portion of the business of the order books has to be readjusted. It has to be more of outside of US, domestic, other markets. So that's what is going on at this point of time.
Mr. Banerjee, morning, Prashant here. Could you give us a sense of the industry? When you say 70% of your business, what you mean is 70% of the production for you happens outside the country.
Yes.
So in that sense, you are less affected. But India business, there is a reset which is underway and I guess ongoing. But for the industry now with these tariffs that we've been living with, what is the situation? I mean, is it for those who are largely producing in India and sending it out to the US? What's the situation?
So you see, like 25% of a penalty tariff, that's something most of the customers said no to. So they said that if you bear this portion of the cost, then we continue with the business in India. So that's, I think, most of the manufacturers of India are taking that hit of that 25% tariff, which works out to be about 15% in terms of our first cost. That means whatever my selling price is, if I go down by 15%, the landed cost after the tariff for the customer is almost the same. So that's how it has been for this last couple of quarters. And that's something I think at this point of time, most of the players, the smaller players are definitely going to give up sooner. And that means there will be job losses and factory closures in India to a certain extent if it doesn't get solved immediately.
Mr. Vij, you want to come in? Have smaller companies given up? Have factories been shut down? What is the data on the ground?
I'm just telling Ram Ram ma'am, if you say this now, 50% tariff already is very high for India, because once we are exporting to any country, it takes us to change and anything takes 6 to 8 months. So all the material was in pipeline, machines were set accordingly, and USA was a very big buyer for us. So this 25% higher is a very big hit for us. If you say this Tirupur market, Karur market, and NCR, Panipat market, all are suffering. And about what we have no option. So whatever the material was in pipeline, we were discounting with 15 to 20%, and somewhat the USA buyer also gave us 2, 3, 4% higher than that, but it is not for the long term. Now we have to see how to sustain further. If you see the data of September 2025 versus September data of 2024, the export from India has gone down by 6%. And from China, of course, China has gone down very much, 50%. But Bangladesh export to USA has increased by 10%. And from Vietnam also, it has increased by 2.5%. So, of course, this America is getting the material from there. And now it will be a difficult time how to go further. Of course, with the government support of FTA and other things,
Right.
we are started looking after the other market, but it will take time. 7 to 8 months is very tight for us, even for the big player. MSMEs are really hit very bad, even with the big player of Gokulnath Das, Wellspan, Aryan, and these are all people are suffering because cotton was the major garment it was going to the America. About out of $12 billion in a year, about $10 billion was going to USA. So cotton is very much hit. Now, one thing is very clear that government, of course, is supporting us in terms of and the credit facilities, but this one, we should have a raw material. Cotton, the government has given us 11% custom duty rebate up to till December, but it has not so far extended. So one thing we need export from the government, that man-made fiber, raw material, cotton raw material, viscose raw material should be at international prices so that we can shift over to the other country. And it is not easy to shift over other country because China, which were exporting to USA, has also dropped down, and they are also pushing to the other countries. So this is the time is there, but it will take 8 to 9 months to adjust these things. Of course, PLI scheme is there. Our Indian domestic market is very good, but it will take. It is a very tough time, next 6 to 8 months, and so that we can find out other markets.
Okay, all right. Got that, sir. Pallab, coming back to you, as you were mentioning that you're trying to de-risk yourself, and that's why a lot of production can happen outside India as well at the other facilities. We'll just pull up a chart, the facilities that you have all across the globe should come out, and Bangladesh is particularly a large part of it. You're de-risking yourself with regard to exports to the United States. But what about the tensions on the border? India-Bangladesh tensions, well, they have perked up a little bit in the last few weeks. Is that a bit of a risk to your business?
Not really, because you see, Bangladesh is very much dependent on this garment manufacturing and exports. So what we are seeing, Nigel, is that definitely the industry is doing fine. There is definitely a political turmoil at this point of time. And there are some benefits also, like, India, the domestic market is buying less and less from Bangladesh. So that might be giving some kind of opportunity for the Indian manufacturers to do more of domestic business. But yes, in general, we are not seeing any change. Also, if you look at it, the Western markets, they are doing pretty well at this point of time economically. We thought that there would be, due to tariff, there would be some kind of slowdown or lack of demand, but we have not seen that. Whether it's US market, the European market, or like even Japan and Australia, I think the markets are doing well at this point of time. So yes, it's a little bit frustrating for being in India at this point of time due to this tariff. We are not able to capture this opportunity. But if I look at as just now Mr. Vij also mentioned, the Bangladesh, Vietnam, and other countries, they're experiencing a good growth at this point of time.
Mr. Banerjee, in August, what was the company's exports to the US? And now what does it stand at? Trying to assess if you have managed to diversify your output to other nations, because that process also takes time. So it's underway, the efforts are underway. But to what extent have you managed to do it? So if you could share some numbers to illustrate that.
So yeah, for example, if you look at Pearl Global, we have almost 70% of our manufacturing was happening from Bangladesh, Vietnam, Indonesia, and Guatemala. And India was constituting about 30%. And in that 30%, we had almost about 50% was a US market and the 50% was the rest of the market. So the trend that we are seeing now is that US market is going slower. That means it's diminishing for India manufacturing. And that part of the business, if I look at US specifically, I'm experiencing a significant growth both in Bangladesh and Vietnam and Indonesia. Of course, Guatemala is favorable for US always. So these are the places where we're seeing a significant growth that's happening, not only for US, but if you see that the Western markets like UK, Europe also have done some kind of FTAs, which are already active in Vietnam now. Bangladesh always had it. So that way, like we are seeing growth in these markets in terms of my order books, a significant growth. If I talk about India, yes, that 50% of the US component is slowing down a bit. I have to quickly replace it by other markets. So that's the transition that we are going through. So maybe like this particular year, I might drop down the India share a little bit just to compensate this, because other important part is US was the most, I would say, attractive market. The order sizes were good, customers were reasonably good, and good pays. I would say the price points were better. As just now, Mr. Vijay also mentioned that there are a lot of dumping happening from China to other markets, whereas US and the Western markets were more clear of, to reduce or de-risk from China. So that's helping in terms of the other markets, whereas for India, we have to compete in all these other markets. United Kingdom, we had a FTA which has been signed, but it's not yet actionable as of yet. European Union, we are expecting, but yes, a lot of geopolitics at this point of time, and we don't know which way it will go.
Okay, all right, gentlemen. We look to reconnect with you all and get an update. Hopefully, things flow in our favor. In fact, companies do battle past this a bit of a difficult phase and then conquer in the time to come. Thanks a lot for joining in and giving us your perspective. Well, the markets did see a bit of a bounce from the lows of the day, but that got quickly sold in too, and we're back down close to around 130 points or thereabouts. Extremely crucial zone. This 25,500, 25,550, extremely crucial zone. You don't want this level to break on a closing basis. For the time being, we slip into a short break. On the other side, Manisha Gupta is waiting for us. She'll turn the spotlight on the commodity space. Welcome back. Markets are still down 130 points, but some of the larger constituents are trying to fight for the bulls. I think HUL is a stock that's now moved to the high point of the day. It can do little, actually, when you have this sort of selling, but that one as well is holding one end up. Interglobe Aviation actually has cut its losses, so that one comes up for you on the screen. I'm not sure whether or not the street is believing that the FMCG index could be the pocket to hide, because that index is trading a little bit in the green. But let's get you some commentary that we got over the weekend, actually. SEBI chairman, Mr. Pandey, indicated that the process of granting an NOC for NSE's IPO is nearing completion. Let's listen in to what he had to say.
I think we are at very advanced stage of issuing the NOC for NSE IPO.
When can we expect?
Maybe within this month.
All right, eagerly watched NSE IPO could be getting a bit of a leg forward. But let's also listen in to what the NSE MD and CEO, Mr. Ashish Kumar Chauhan, had to say on the potential IPO.
Today we had a great darshan in the early morning at Tirupati Tirumala Devasthanam. We took blessings for NSE and for all our members or our shareholders and the country. Yesterday only the Honorable SEBI Chairman announced that this month NSE will get an approval for IPO, and we had planned this Tirth Yatra long back, but it happened that yesterday only when we arrived in Tirupati, the announcement was made, so we think it is a good omen and God's blessing that this announcement has come from SEBI.
Well, the SEBI chairman also commented on the further course of regulatory action in the derivatives market. Let's listen in to comments on that front.
In the derivatives, we have taken a number of measures, as you know, earlier, first in October 24, and then in May 25, and the last of the measures got kicked in December 25. So we are looking at the data, and after the data is there, we will be able to define our next course of action. So at this moment, I don't think that we are going to disturb anything.
Okay, all right. At least we've cut our losses by close to around 50 points from the low point of the day. Coal India has moved up a little bit. I don't know, maybe, actually the Nifty Bank, that was down 280 points. That's cut its losses, and that definitely helps because it's the largest constituent of the index. It's gradually moving towards the 20 DMA. Boy, oh boy, I'll tell you what, the bulls will want it to get closer to around that mark on a closing basis. For the time being, some bit of a relief rally. To be fair, actually, the Nifty has cut its losses by half from 160 points down. Now we're down only around 80 points, but we need to sustain these sort of levels and then hope. First, the Nifty needs to stop falling. And then since you have a market that's net short, the odds of seeing a short covering bounce actually move up. So that's the important trigger on the index. Let's address a couple of pockets of stocks, though, that are reacting. Vinny joins us to tell us about the capital goods stocks. Vinny?
Hi, Nigel. Good morning. So these capital goods stocks, if you see, since the second half of last week, we've seen them see a fall coming. And why? First, there was a report that came in that Reuters said that there's a high-level government committee that came in. They're recommending that, Chinese firms now could start bidding for these government contracts, especially coming in for power, railway and other sensitive contracts. Now, these restrictions were placed on these contracts when? In 2020. Now, obviously, there's an impact that comes in for all these companies if these restrictions are lifted. So, we started seeing a sharp correction coming in. When you look at L&T, BHEL, which are mainly into boiler turbine generator suppliers. So, BHEL, these were the contracts which they spoke about that maybe the restriction could be lifted on this one. Hitachi Energy, GE Vernova T&D, Siemens Energy, CG Power, they are in the power sector equipment play, as well as other stocks like transformer rectifiers, ABB, Siemens. All of them also fell in trade or are falling even today. Why? Because they're a part of this manufacturing supply chain. Then there was a clarification that came in, also reports that was suggesting that, maybe this is not going to be happening. And as of now, as per CNBC-TV18, the sources also suggested that no decision as such has been taken on this front. So that was an important update. But despite all of this coming in, there was no respite for any of these stocks. Today also a sharp fall continues for them. Now, what are brokerages suggesting? Whether you look at something like an IIFL, we spoke to Renewbet today as well. What is suggested that Chinese company TBEA is likely to participate in this power grid tenders, and only restriction maybe is likely lifted for only these high voltage transformers or reactors. On those fronts only this restriction is lifted. This is according to the channel check that she suggested, but not as a whole for the sector as a whole, that Chinese companies can participate across the capital goods or industrial sector. It's not across that. That is what brokerages are highlighting. Even IIFL said that as well. Now, Jefferies also is saying that if this actually happens, highest impact coming for BHGL, L&T, Afcons, ABB, CG Power, low impact for defense companies, and T&D companies would see a lesser impact coming in as well. Bernstein also said that industry checks are suggesting that relaxation is only in some of these sectors, not all of the sectors, or some particular products. So important update is that if it comes in, it could be only for some particular products. As of now, there's no decision that's coming on this front, but pressure continues on the sector.
Thank you very much for that. It's over to Sudarshan now for more on Meesho and Grow.
So, two initiation, BofA Securities has initiated coverage on Meesho with neutral call and targets given is of 190 per share. It says company is well placed to target value-focused mass market segment, and it believes in FY 26 to 29, NMV CAGR can be as high as 26%. And adjusted EBITDA margin from FY 26 that company had reported of -3%, it can increase to more than 3% by FY 29. So, from -3% FY 26 to +3% by FY 29. And at current levels, valuations are factoring strong fundamentals, and tailwinds are room to gain market share, fintech scale-up, and grocery expansion if company plans to undertake. Second one is Kotak Institutional Equities has initiated coverage on Grow with a buy call and targets given of 190 per share. And its constructive medium-term views factors in few positive catalysts. First, durable product-led growth flywheels. Second, expanding monetization across broking, margin lending, wealth, and consumer credit. And last one is scalable in-house technology. So positive brokerage notes for Meesho and Grow.
Okay, all right. Thanks a lot for that, Sud. Well, let's also focus on a couple of these other names. Premier as well as Wari, they are in focus post the news flow coming in for China over the weekend. Vivek joins us to decode that for us. Vivek?
Well, that's right. So on January 9th, the Chinese Finance Ministry went ahead and cut export rebates, cut the kind of support they were giving to a whole host of value chain additive companies across quite a lot of sectors, key amongst them being the solar renewable energy sector. Now, what actually has China done? China has gone ahead and cancelled value-added tax export rebates for photovoltaic products, and this will be effective from April 1, 2026. Now, remember, China had previously reduced the export tax rebate for photovoltaic products to 9% from 13% in December 2024. So now, overall, how do we look at this particular impact as far as the India value chain is concerned? A whole host of PV modules, cell companies will marginally benefit. So names like Premier, Wari, even Vikram Solar, MV Photovoltaic, all of these names marginally benefit, and even a name like a Borosil Renewable, given the fact that solar glass too comes at much cheaper rates from China. But one important thing to note is that the Indian domestic market already has quite a bit of support. There is a 40% ADD on solar modules, a 25% ADD as far as solar cells are concerned, and along with that, there is also support in the form of ALMM, which is the approved list of module manufacturers, and also an approved list of cell manufacturers. Only those companies incrementally will be able to supply to renewable energy products. It's a mild negative for RE developers, but a marginal positive for PV module makers as well as cell suppliers.
Thank you very much for that. Almost 10 o'clock. Let's just get in Vinay Rajani of HDFC Securities now for a quick technical check on the market. Vinay, tough morning, tough start to the week, but markets trying to bounce back a tad bit. What is your read of the first 1 hour of trade? And would you have a strategy on the Nifty, Nifty Bank, and any of the big stocks?
Yeah, good morning. So tough day, definitely. And it has been 6th consecutive day of fall. And Nifty has already witnessed a 850 points fall from the recent swing high of 26,373. So it has been quite weak setup, and we have been underperforming the global markets. Despite positive cues from the Asian markets, we are not able to recover. So that is a bad sign. Positionally, we are now below 50, 20 and 100 days exponential moving average. That is also another weak sign. But yes, since we have fallen a lot in last 6 sessions, we cannot rule out the possibility of the pullback in the market. So yes, there was the previous support at 25,700. Up to that level, we can see some recovery from this level. So risk reward ratio is not favorable going short over here because it looks oversold on the short term charts. So I'm expecting some pullback rally to come in the Nifty in the range of 25,700 to 25,750. There could be a bounce up to that level. So better to wait for that level to come, and then you can think of going short again. But as of now, it looks quite oversold. Wait for a pullback, and pullback should be around 25,700 to 750. And Bank Nifty also closed on a weak note. So in that also, it would be better to wait for a pullback, and then we can execute the short strategy. So oversold right now, but positionally definitely it is weak. So lighten your commitment at higher levels.
Okay, all right, got that. Oversold, a bit of a recovery, but you could lighten yourself if in case you do get a bit of a bounce. Vinay, what about individual stocks? Give us some ideas.
Yeah, so looking at the global commodities, industrial metals strength, I still feel that the stock like Hindustan Copper can do well. So it has been very strong in recent past, and still looks like that it is headed higher. So Hindustan Copper can be traded long around 528. I would suggest a stop loss at 515. On the upside, I'm expecting a target of 515 in a couple of sessions. The another strategy would be to sell in the some of the capital goods stocks like Cummins India around 4050, 4070. One can look for shorting in the January future. I would suggest a stop loss at 4130, and on the downside I'm expecting a target of 3980. So Cummins India on the short side, which is January future, and Hindustan Copper on the long side with a stop loss of 515.
Thank you very much for that. And now let's turn our attention back to the commodity markets. Manisha is now joining in. Manisha, what are you looking at?
Well, all-time highs that the precious metals seem to be trading at is something that we'll need to talk about, because gold is now trading at $4,600 an ounce. We have seen prices gain up by 4% in the previous week. And when you look at 2025, as we've been discussing, it had gained 64%. So the rally really started in the 2023 in the month of September. But from the 1st of January to where we're trading right now, gold prices have given you 140% returns. If you look at overall demand, apart from the geopolitics and macros as well, the estimates are that for 2026, the demand for gold globally could hit 4850 tons. Now, this is the highest since 2011. So we seem to be making records in various directions there. Take a look at the silver prices. 4% of gains is what we started Asian markets with. Last 1 year has seen 182% of gains come in for the silver prices. And this year, so far, we already have done 17% of gains there. Support clearly coming in from the weaker than expected U.S. payrolls data. Markets were anticipating a 66,000 of a number. What we got on screen was 50,000. That has led to a decline in the U.S. dollar index, supportive for precious metal prices. The street also estimates that with the kind of jobs numbers that we are looking at, you could be looking at least 2 rate cuts in the year 2026, and that in turn also has been supportive for the prices there. Also, it has been about safe haven buying. The US-Venezuela tensions has been supportive for gold prices in sense of tangible buying there. And then there is also unrest in Iran intensifying. That has been supportive for global gold demand. The dollar index declining as a criminal investigation on the Fed chief, Jerome Powell, puts Fed independence into question, has been one of the reasons that we've seen a lot of safe haven come in for the tangible commodities. So when you look at what the markets will watch out now for, is in focus is the U.S. inflation data, and the key bank earnings this week is what the markets will take cues from. In the meanwhile, you also have, over the last 2 or 3 days, seen more reports coming from the international banks. UBS for now has changed its estimate for the gold prices, and this year they believe that $5,000 an ounce is a possibility by the month of March. HSBC, in the meanwhile, also says that the first half of 2026 could see $5,000 an ounce for the gold prices. Last split should come in on your screens, which shows you on what we've done in sense of commodities for 2026 till time. So gold price is already up 6%. Silver outperforming yet another year until time, at least 17% of gains coming in for this one. Copper, we've seen all-time highs in the previous week, and we've seen 5% of gains already for this year. Crude prices, 3 years of decline. This year has started positive, 4% higher. Aluminum is gained 5%, and platinum continues to be in that race as well, 15% up already in 2026 for that one too.
Okay, all right. Thanks a lot for that, Manisha. For the time being, we'll slip into a short break. On the other side, an exclusive conversation with the Asia head of private equity, Warburg Pincus, on their 960 crore rupee investment on Lemon Tree Hotels and more. Stay tuned.
Hello and welcome to this edition of the Newsmaker. Over the weekend, a big deal in the hospitality space. Lemon Tree Hotels has announced a strategic reorganization of its business, creating two distinct platforms: an asset-light hotel management company and a scale hotel ownership and development vehicle, Fleur Hotels. As part of that transaction, Warburg Pincus, the private equity giant, is acquiring APG's entire 41% stake in Fleur Hotels and committing up to 960 crores of fresh primary capital to support its next phase of expansion. It is also a renewed partnership. Warburg Pincus was an early backer of Lemon Tree nearly 2 decades ago, helping build what is today one of India's most recognizable mid-market hospitality brands. The latest investment comes at a time when India's travel, tourism and discretionary consumption cycle is seeing a structural upswing supported by infrastructure build-out and rising domestic demand. With such a landmark move to kick off 2026, we thought it would be the perfect opportunity to speak with one of the primary architects of this strategy. We are joined today by Vishal Mahadevia, Managing Director and Head of Asia Private Equity for Warburg Pincus. Vishal also serves as the Global Co-Head of Financial Services, a role that is particularly relevant given the firm's recent successful $3 billion close of its third financial services fund just a few days ago. Well, this interview also comes at a momentous time for Warburg Pincus as the firm celebrates its 60th anniversary this year. Since its founding in 1966, the firm has become a pioneer in global growth investing, now managing over $100 billion in assets across more than 215 portfolio companies. In India, Warburg's journey began in 1996, making them one of the earliest and most successful global PE firms in the country, with roughly $10 billion invested in India to date. Their portfolio reads like a who's who of industry leaders, from the early success of Bharti Airtel to current powerhouses like IDFC First Bank, CAMS, Kalyan Jewellers, and many more. Air India has, of course, been one of the large new bets as far as the consumption space is concerned. Vishal, of course, has been at the center of that journey, helping deploy capital through multiple cycles, build scale platforms, and deliver some of the market's most closely watched exits. Vishal, it's a pleasure to have you with us here. Thank you very much. Thanks. Congratulations on the big deal with Lemon Tree. And of course, I mean, at the outset, let me say congratulations. 30 years of Warburg in India, 60 years of Warburg, as a firm.
Thank you, Prashant, and it's great to be here. Thanks for having me. It's actually quite amazing. 30 years, 3 decades in India when we first came out here. I think the economy was less than $500 billion GDP. It was really not on anyone's radar. And being here for 30 years, through ups and downs, through all these cycles, we're just terrific. So happy to be here. And we're lucky that we've been able to partner with some of the best entrepreneurs. And you started out talking about Lemon Tree, but to be back with Patu, as when we just started more than a decade ago, working with him, it's just been terrific and great to be back with him.
We'll come back to a little later in terms of the journey of Warburg itself and what's ahead. But Lemon Tree, you're coming back in a way, right? Because you were there in the beginning 2 decades ago. Small company, it's a very large sort of company now. What's the logic? And just tell us a little bit what investors should expect now after this transaction goes through.
Sure. Look, I'll give you 2 very simple reasons we're back with Lemon Tree. And number one is Patu. I think in India, in 30 years, we've seen who you do business with, who you partner with, is much, much more important than the company that you invest in. And so a chance to come back with Patu and his entire team and seeing how they've grown and built really one of the leading hospitality businesses in India is terrific. 2, I really think hospitality is at an upswing. You've got all the reforms, the infrastructure build that's happening in the country. You've got a more affluent consumer in the country that's aspiring, that wants more. And as you have this increase in domestic travel, not just tourism, but even business, even overall larger and larger companies, I think Lemon Tree is in a great position to benefit from that. And really, with our capital and hopefully with our partnership, grow that business.
You're also buying out APG's 41% stake in Fleur, right?
Yes.
What was the logic there? And was they had to get out? They wanted to sell, and what? Just talk to us a little bit about that.
I won't comment on APG, but I would only say they've, as they've said publicly, they've done very well. They've been great partners for Patu. But like all financial investors, there comes a time when you've generated very good returns for your partner, and the partner needs an exit. And we were lucky enough with Patu to be able to buy out the stake, come back in and be a partner with him and not just buy out their stake, but really provide this additional capital to help grow Lemon Tree, which is the fuel, again, for the hotel business.
So actually, the overall transaction is much larger in that sense.
Yes,
right?
it is.
There's that 41% for what you're paying. I mean,
that's exactly right.
A meaningful sum, and then there is this primary capital of 960 odd crores as well.
That's right. The overall transaction size is multiples of the 960 crores. And hopefully there's even more of that in the future, because we are very positive on both Lemon Tree and the hospitality business in India.
And this, I mean, the logic behind asset light and, I mean, asset heavy, is two distinct entities now, right, in that sense?
I think there will be two distinct entities because two have very different capital needs. And really someone with our capital and the scale of our capital should be in the asset-heavy entity to help them continue to grow where capital is required and us to come in. And there is a asset-light business at Lemon Tree that will continue. And both will really continue to thrive side by side as they become public companies.
Typically, I mean, this kind of a bet now is going to run for how many years? I mean, this is you're in it with no finish line in that sense?
Yeah, no finish line, only because it's so hard to find good people and good companies to invest in. And when you find it, as in private equity at least, you then want to be in there.
And then come back.
Continue there.
Come back.
Yeah, exactly. Why not? Why not?
The investment in Air India, right, with Bharti Enterprises. And of course, I mean, you work with Bharti. It's been one of the oldest associations here in India in that sense. Again, it's a consumer bet. So talk to us a little bit about that. What do you aim to achieve with that one?
Yeah, look, Haya India, amazing company. They've grown 25% compounded annually over the last however many years, grown to become the #3 brand in India in white goods. We've known Haya very well for years. We've known Sunil, of course, go back to our early days in India since 1999. When we made our first investment in Airtel, when it was just a North Delhi cell phone company. And we've come back again with Sunil in the past. So it really is, you see a little bit of a theme. Who we do business with is important. And a chance to partner again with Sunil, to partner with Haya in this new structure, and then create another Indian champion. Make in India, make for India, alongside Sunil, who understands the Indian consumer as well. I really think it's a terrific cocktail. A lot of hard work, a lot of execution required, but the opportunity is tremendous. Again, affluent Indian consumer. They want to buy better goods. They want value for money for their purchase. They trust brands. They want better technology. So all in all, if you can pull all of that together, I think Haya in India can have tremendous success.
You know, the big story for the last 15, 20 years with regards to the consumer in India is that, I mean, we all used to look at what's happened in China and say, well, you know, look category by category. What's happened here, there will happen here. I mean, you know, per capita consumption of this and that, etc. I mean, everything from ACs to footwear to everything. I mean, you have extensive amounts of experience in China. You travel extensively across Asia, for that matter. Is that thesis still correct? I mean, that is the broad way to look at it, or is there a change?
No, I think I would say India will develop very differently in terms of both the speed and the level of its penetration rate and what consumer categories India will have. But the direction of travel is undisputed. In fact, what really changed, I think, for India and accelerated that trend from unbranded to branded, from unorganized to organized, was COVID. That actually changed everything. People were more comfortable using technology, buying online, paying online, digital payments, everything enabling that system, along with the government regulation that happened, you know, a decade ago. It just accelerated this trend. And so you have the Hayas of the world. We invested in a company called EBCO, in a company called WaterTech. As you go down that list, I think that trend has accelerated. It was always there, but Haya sits in the forefront of it.
So from a consumer perspective, the broad bet is premiumization across categories.
I think
that is what you're betting on.
I think the broad bet is premiumization at every level. So someone at the bottom of the pyramid is premiumizing what they used to buy, and someone in the middle of the pyramid is premiumizing what they need to buy. So it's not just premium products. I actually think you want to be able to serve that mass market in India, but every Indian consumer is aspiring to buy a slightly more premium product. And you have to be able to cater to that with good value and better products.
what we're going to do, Vishal, is take a quick commercial break here. We'll talk about financial services. So many transactions lately. You've closed a very big fund, and I'll ask you where you plan to invest and put some of that money, especially in the Indian context. So stay with us. We are back with Vishal Mahadevi of Warburg Pincus in just a bit.
Welcome to the Syngenomics, which is a very important one on the capex cycle. The GDP advance estimates announced last week showed a very strong rise in investments, or what the GDP data calls gross fixed capital formation. Investment is seen rising by a strong 7.8% for the full year, real GDP, versus 7.1% last year. And for only the second half of this year, investment is seen growing by 8.1%, 7.6 in H1 and 7.4 year ago H2. So strong data. The data also shows that if one went only by nominal GDP, the share of investment in total GDP is 30% or 107 trillion rupees. Now, the central government's capex is budgeted at 11 trillion. While the states have budgeted around 10 trillion, they don't always reach that number, which means over 80 trillion or 80% has to come from the private sector. So, is the private sector capex that good? That's the question we're asking. And joining us is Mahesh Vyas, founder and managing director of the Centre for Monitoring the Indian Economy, and K. Ravichandran, chief rating officer at ICRA. Gentlemen, good morning and thank you very much indeed for your time. Mahesh, directly that question to you. Your private sector data that you gave me, and we will flash it, is showing a seminal step up after around 2022. But is it strong enough? What's your overall sense?
I think it is strong. It's not great. It's not like the roaring investment cycle that we had a few decades ago, but it certainly is perceptible.
Okay.
Compared to what we saw in the preceding 5 quarters, the most recent 5 quarters certainly show there's a pickup in investment, and that investment is led by the private sector. Okay. And happily, that's also led by the manufacturing sector. So I would say that there are good tidings indicating that private sector investments are picking up.
Okay. But what about the completion? You also gave us a list of completed projects, and whereas at this, a decade ago, the percentage completion was about 25%. Now the percentage completion seems to be only 10%.
Yes. Nevertheless, the completions this year in the recent past compared to the earlier times is still better. I agree that the completion rate has slowed down, but I think these numbers will get revised.
Okay.
The earlier numbers are fully revised, all revisions taken care of, whereas the most recent year's numbers will get revised upwards, and this difference will reduce.
Okay.
And nevertheless, this doesn't take away from the starting of an investment cycle, which is you begin by new investment announcements.
Okay.
And
Fair
it
enough.
takes time for completions to catch up.
Fair enough. And FY24 seems to be really strong with private sector investments at some 32 trillion in terms of announcements. Mr. Ravichandran, thank you for your patience. Well, the eye-opening part of the private capex cycle report that ICRA put out is that private sector actually forms a very small part of overall investment. It's only 32%. And within that, the listed universe is only contributing 5% of overall investment. Can you give us a perspective? Is that 5% at least growing?
Yeah, so in the case of private sector capex, the story is very different between listed and unlisted companies.
Okay.
If you look at the top 20 business groups in India, most of them are going ahead with their capex plans, whether it is in the new economy, like the renewable energy, battery storage, pump storage, and electric vehicles, and so on and so forth. In addition to traditional old economy sectors like steel, refineries, petrochemicals, and so on and so forth. In our estimate, capex with these large companies, industrial groups, has been growing in double digits, 12 to 13%.
Okay.
Whereas the story is very different in the case of unlisted space. Unlisted space accounts for almost 80 to 85% of the overall capex. That is where the problem lies in, where we believe the capex has been muted and it has been growing in single digits, perhaps 4 to 5% kind of a growth. A lot of SMEs and small enterprises, where because of the external demand environment and domestic related demand related factors, there was no need to add capacity, and import threat was also fairly at a high level. Because of that, unlisted space is where perhaps we require more attention. On the listed space, large conglomerates, they are pretty much going ahead with their stated capex plans.
Okay, but Mr. Ravichandran, are you getting the sense that Mahesh Vyas's data is showing that there is a kick up from, say, post-COVID, say 23, 24?
Yeah, certainly. One can see that from the wholesale credit growth as well. While till now, one of the major issue has been that companies were not borrowing much. While capital formation was happening, it was not getting reflected through credit growth, because a lot of the capex was getting funded through internal accruals, and there was no need to tap either the bond market or the bank loan market in a meaningful way. But of late, even that also has been gradually showing signs of improvement, and largely it is coming from the both the kind of sectors, clean energy sectors as well as old economy sectors. We believe the capex has been inching up, and largely to do with domestically, to address the domestic demand, while export focused businesses are somewhat affected. But with regard to domestic demand per se, whether it is steel consumption, cement demand, or oil and gas, petrochemicals, etc., where it's largely domestically focused, and to the extent that there's no need to be worried about demand-related issues.
Fair enough. Mahesh, CMI has been doing this for what, last 3 decades or even longer, the collection of private sector data. I think I came to the CMI library as a student, maybe in the late 80s, if I remember right. Now, what is the perspective you have? You're saying that there is this very good kick-up in overall investment as well, post-22. How does it compare with the historical trend?
Well, so one needs to see the nature of the cycle. That there has been a prolonged, rather very prolonged period of extremely anemic growth in private capex. A very long period, almost from 2011-12.
Okay.
And compared to that, in the recent times, there is a pickup from 22, 23, and so on and so forth. That, compared to the most recent part, is a perceptible increase. But compared to what we saw in the, let us say, in the decade of the 1990s, that was something completely different. That was an order of magnitude much bigger than what we saw now. And I also agree that the investments are more concentrated in the larger enterprises, in the larger conglomerates. So the smaller companies are not investing as aggressively, but there is a new thing now is that there are many more startups coming with very aggressive capex plans. Not talking about the IPOs, which are largely not capex, but still there have been in the recent past a lot of new capex which is happening by new startups. So the nature of investments is changing. It is not as aggressive as it used to be in the past, but there is a change. There is not just the capex database that you alluded to, Lata, that I will point to. I always compare this capex data with the net fixed assets growth of the listed companies and even the unlisted companies. And if I see the listed companies, because we have the September 25 results now, what we see over there is if I look at the 5 quarters ending September 2022, the average growth in net fixed assets was 4.5% year-on-year growth. And in the next 5 quarters, that growth goes up to 6.5% average. And the average is a good average. These are not some outliers canceling out. They're very close. 4.5 moves up to 6.5. But September 25, that number is 9.5. So, this is an indication that there is an increase in the capex cycle going on. These numbers used to be of the order of 20% in those great days.
You mean 90s or 2000s?
In the 2000s. Okay. In the 90s. 97, 98, 96, 97, 98, 99, that period, we saw 20% year-on-year growth in capex. But let's not belittle even this 9.5%. It's come after a very long time.
Okay. Well, that's good to hear. Mr. Ravichandran, a slightly unfair question in the sense it's an economist's question. Both you and Mahesh agree that you are seeing a step up in private sector investment from in the post-COVID period. And we know the data is very clear that government capex has, risen manifold in the period. Let me just inform our viewers that government forms a very small part. Central government, it's just 10% of the overall GFCF, gross fixed capital formation. But that said, Mr. Ravichandran, would you say that points out to a period of higher productivity and higher margins since so much investment is happening?
Yeah, in fact, if one were to look at this ICAR, the incremental credit output ratio.
Yes.
Where India has been one of the best, in terms of capital efficiency. So from that point of view, our investments are really delivering in terms of achieving this kind of a growth. That is something one can see from the stated the economic indicators.
Okay. Yes, sir. ICAR, I didn't want to use the jargon, but you're right. Capital output ratio, incremental capital output ratio does seem to be falling. You're getting more output per unit of capital that's coming in. Mahesh Vyas, would you say, therefore, that we are on the inflection point of probably a good capex cycle?
There are indications to that. I would still not say that we are at that inflection point, but we certainly seem to be heading towards that.
Okay. And Ravichandran, last word?